Okay, so hello everyone. Welcome back. We are sorry that we stopped for a while because we had to sort out some scheduling problems. This is our new sponsor teacher, Mr. Bolognese. He is our geo teacher, so he'll be sponsoring us right now. We have quite a bit of time now, so we will be starting every lesson with a current event. Now, does anyone know what current event we're doing today? Brandon, what current event are we doing today?
We're going to talk about GameStop and rising price.
Yes. Does anyone know what happened to GameStop in the past few weeks? Just one of you. Who here's on Reddit? Wall Street Bets? Are you on Wall Street Bets? Okay, so for those that don't know, oh shit, this isn't on. All right, this is GameStop over the past few months, right? And as you can see, something that's happening right now, it is going crazy high for absolutely no reason, because there's nothing, for absolutely no reason, right? Because there's nothing that's driving the stock's price besides something called a short squeeze, which we'll talk about. So, who here knows what it means to short a stock? Brandon, do you know what it means to short a stock?
You basically like borrow it like your.
All right, we're gonna talk about what a short is starting. Can you close your projector to my face? So when you go long a stock, do you guys know what it means to go long a stock? It's just a way of saying you're buying the stock, right? So if you go long a stock, let's say, can you hit record, please? Okay. Let's say you are here, right? And this is $100. If you're buying long the stock, you're wishing the stock will go up, right? Because if it goes to 120, how much money do you make per share? You, Harry, how much money do you make per share if it goes to 120?
$20.
Right. But what it means by shorting the stock, it's that you're betting the stock will go down, right? You're wishing the stock will go down. So here's what you do. Let's say you want to short the stock, right? That means what you do is you don't buy the stock. You borrow the stock from someone else, right? And then you sell it right now for $100. Does that make sense? So let's say I want to short a stock, right? Leo has the stock. Let's say call it ABC right here, right? This is our company ABC. So I want to short the stock. Leo has company ABC. What I'll do is I'll borrow the shares from Leo, right? I'll sell them right now for $100. And what I wish to happen is that the stock will go down to here, right? Let's say it goes to $80. Now what do? It goes down to $80. I'll buy the stock back at $80, right? And then give it back to Leo. So how much money have I made? Shreya. Right. So you're wishing that the stock will go down, right? And this is essentially what is called a short. You're shorting the stock, right? You're borrowing it, you're selling it, and you're hoping to buy back at a lower price. Now, what's one really big problem with this, a short, in terms of risk? Kai, right? Yeah. What's one problem you see with shorting? One really big risk that you see?
Like, I don't know, if your stock is rising.
Let's say this doesn't happen, right? Let's say this is potential. But let's say it goes up.
Then you're losing a lot of money.
Yeah, Chris, yeah.
They can go up.
Exactly, right? If you buy the stock at $100, most you can lose is it goes to zero, you lose $100. But this thing, right, you short at 100, it can go up to infinity, and then you have to buy back infinity, right? Theoretically, it can go to infinity. And this is what is happening to GameStop. A company that I shorted. And then Brandon right here went long on the stock, so we're betting directly against each other. So, Brandon, tell me why is the stock going up even though nothing has happened?
Well, there's a short squeeze happening.
Let's start from the beginning. What really drove the first rally? Rally just means the stock is going up, right? What drove the first rally?
Not Reddit.
Right. Yes.
No, Wall Street shorting the stock. That's on that.
No, not based this year.
Yes. So there's something called a stocks float, right? Can you guys see over here or no? Can you can't see? Do you want to take my spot? Take another spot. So there's something called a float, right? Do you guys remember outstanding shares? We talked about outstanding shares last week, or in the first meeting, right? Outstanding shares. What is outstanding shares? Janet, what's outstanding shares?
Shares are like available.
Right. Let's say there's 100 million shares available, right?
Yes.
The float just means that the amount of shares that are available for trading. So if there's 100 million shares available, do you think the float will be $100 million? 100 million shares? No, right? Because not every single share is available. Let's say this is company ABC, right? There's 100 million shares outstanding. The float can only be like, say, 50 million. What that means is, say, 50 million shares can't be traded because they're owned by institutions. Institutions are like the big funds, right? They're the funds, the retirement pensions. They're not going to be trading stocks a lot. Or they're ETFs, which we're going to talk about later. They can be held by institutions, so you can't trade them. And then say 20 million of it is held by insiders, so management, right? The management team. The management team cannot sell their stock because of something called a lockup, right? So 20 million shares can't be traded. And let's say further 10 million can't be traded because for employee compensation, right? A lot of companies pay their employees in stocks. So let's say these stocks are locked up. So you add this up, there's 80 million shares that can be traded. So what's the float of the company? Leo, what's the float?
20 million?
Yeah, so only 20 million shares can be traded, right? So GameStop, it's a company with a very little float, which means there's not a lot of shares available for trading, right? And 150% of their shares are held in short interest. So that means 150% of available stocks for trading, right, are being shorted. Someone has lent that share, sold it, and they're waiting to buy back at a lower price, right? And now, then, we're gonna talk about something called a short squeeze. Brandon, what's a short squeeze? Sure, I'll explain. Let's go back to our graph here. So, let's say we are here at this point, right, at $100. And then let's say 150% of the available shares are held short in the case of GameStop, right? So most of the shares that are available for trading are being shorted. Let's say the stock goes up to 120. And what happens? What happens, it's a short sellers, right? They get panicked. They feel like, oh my God, I feel like cover this thing. Cover just means you're buying it back and paying it back, right? So you're giving back the shares that you borrowed. So what happens when you cover the shares? Harry, what happens when they cover the shares?
I don't know.
So, yes?
The stock price increases?
Yeah, because these guys, right, they have to go and buy the stock. So it's called a short squeeze because the short sellers, they get a rally, right? They have to go and buy the stock. And that pushes the stock even higher. In the case of GameStop, there isn't a lot of shares for trading, right? Say there's no shares. The short sellers get squeezed, meaning they have to cover their position, right? They have to buy the stock back and pay it back. What happens is they start bidding against each other because there's so many short sellers going after so little stock. So then what happens is, you see this, it just goes straight up because there's no shares available for trading, and that's what's happening right now. And if you know, I have a short position in this, which means I'm getting burned pretty badly. All right, questions. My question is, should I continue my short or should I cover? I can wait until this thing goes to 500 before I run out of capital and I have to cover. But, are you making fun of me? Sorry. Yeah. Brandon, what do you think? Should I cover this? Okay. What about Kai?
So wait, how long do you have until it, like, you can't buy it back? Like, is there?
Okay. So, there's enough, okay, so let's say I shorted here, right? So I sold it at here, and this thing's keep going back, and I have to buy back and pay back the shares I borrowed, right? This thing can go until $500 before I blow up all the money in my account, and I have to buy back. Because if it goes past $500 per share, right, I can't buy back anymore. Right, so I have until 500. What's it trading at right now, Brandon? This is from this morning, but this is such a volatile. Remember volatile? When we talk about volatile, it means it moves a lot, right? This is such a volatile stock that by now this is outdated. What's it trading at?
It's only at 325.
Still doesn't matter. I'm still losing money, but. All right, so let's get started. Today we're going to talk about, remember the first Kahoot we did with you guys? We're going to go over the answers of that one. And Philip is going to get us started on insider trading. So first question is insider trading legal? Put your hand up if you think insider trading is legal. If you think insider trading is illegal, put your hand up. Okay, cool. Let's get started. Philip, want to start us off?
Okay, sure. So insider trading is essentially trading on a public company's stock with knowledge that isn't readily available to the public. So for example, let's say Shreya is the CEO of a pharmaceutical company, right? And they're trying to put out a new drug onto the market. They have to go through the FDA within the US to get their drug accepted to put on the market, right? FDA is the Federal Drug Administration, right? And during that trial, the drug ends up getting rejected, and management is not known of that issue before the public in this situation, right? And then let's say, Shreya, with that information, goes ahead and sells stock of that company because she knows the company's not doing well because that drug just got rejected, right? Would that be considered insider trading?
Yes.
Yeah, because Shreya is trading on information that's not readily available to the public, and that gives her advantage as opposed to other investors. And in this case, it would be insider trading.
Yeah, so what it means is
What's a railroad mean?
people want, the SEC, right? The government wants to keep the market fair for everyone. They want people to have confidence, right? So with the information, you can only trade on information that everyone has. The most common case of insider trading isn't even pharmaceuticals, right? It's called earnings reports, right? So what we talk about is every public company, they have to report how much money they make every quarter, right? The thing is, the company insiders see that information before it gets released, right? So they can trade off of that information. If they know their company had a really good year, they know it before everyone else does, right? So they can trade off of that. The second thing is, even journalists have access to information before the public does, right? Let's say the journalist discovered fraud at this company, right? They cannot trade the shares until they publish a paper because they have inside information about the fraud, right? Does that make sense? Yes.
Was there anything, any rules or regulations that would like stop them from doing that, like mitigate them? Because I know insider trading is something that's really easy to do. Are there any rules against that?
Yeah, no insider trade. Okay.
Yeah, but that's
So do not trade on insider information that is public moving. That is market moving, right? Let's say your dog dies. That's inside information, but it's not going to move the market, so like no one cares, right? But not that no one cares about your dog, but like the market doesn't care about your dog.
Yeah.
So you're right. Like I talked about this with your brother last year with Ricky. Why it will be good to commit insider trading. I'm not saying that you should do it. I'm just saying that the odds are in your favor because one, it's hard to prove. How do you prove someone knows something? That's hard to prove, right? The other thing is the penalties are not that bad. Like 2-year maximum with some fines. These are why. I'm not saying you should commit them, but I'm just saying this is a nice club. Not saying you should commit insider trading, but just saying like it's not that bad. It's bad, but not too bad for punishment. Does that make sense for everyone? Insider trading. All right, we're going to go to diversification. Can I have my thing? So the question was, I think, what does diversification do for a portfolio? Shreya, what does diversification do for a portfolio?
There's less risk.
Yes, less risk, but how?
Because you have stocks like different companies, so if like one goes down, you still have others to.
Good. Yes.
Your success isn't reliant on just one variable. It's spread out in multiple baskets.
Yes.
And then the other
Yes.
would be this.
Like we've all heard of the term, right? Don't put all your eggs in one basket. We've all heard of that, right? This is essentially what explains what goes behind that. So this graph here, right? It's something called the holy grail of investing. Don't worry about that right now. But what I want you to take away is, first off, there's two types of risk, right? Idiosyncratic risk, which is something called company-specific risk, right? So what's a company-specific risk? Henry, what do you think it's a company-specific risk, say for Apple? What's a company-specific risk?
Making sense there.
What's one risk? Sure, so I'm sorry. Yeah, Chris.
CEO getting murdered.
Yeah, that's something like a company-specific risk, right? Now what's a market risk? Kai, what's a market risk? Yeah, that's a recession, right? So there's two types of risk. One is the idiosyncratic risk, and the other is called the market risk, right? The idiosyncratic risk, or company-specific risk, it's the risk that only your company suffers, right? But the market risk is something that the entire market will suffer from, like say a recession. So what diversification does, it eliminates, or at least minimizes your idiosyncratic risk. So what I have here is an example, right? Let's say, this is investor A, right? He has one stock. Let's say the stock, right? It has a 2/3 chance of doubling, and a 1/3 chance of going to zero. Now, do you think he's expected to make money or lose money? Nagar.
Make money?
Right, because the odds are in his favor, right? But here's the thing: he has a 1/3 chance of failing, right? So what he does is he buys this one stock. He's expected to make money, right? But let's say investor B here, right? He buys 10 stocks. They're not the same stock, right? But they have the same return, risk and return. So they all 2/3 chance of doubling, and 1/3 chance of failing, right? But he does this over 10 different uncorrelated stocks. Now, the expected value is the same. So expected value just means how much value you're expected to get from a bet, right? Let's say I'm flipping a coin with Chris, right? Heads you win $1, tail I win $1. What's the expected value of the bet? No, 0. You're not expected to make money from it, right? You have a 50% chance of getting $1, and you have a 50% chance of losing $1. So theoretically, your expected value per play is $0, right? Let's say we flip that coin again. Heads you win $2, tails I win $1. What's the expected value every flip? No, close, but think again. It's 50 cents. Because look, heads you win $2, right? Tail I get $1. So $1, right? You're supposed to win $1. You're expected to win $1 every 2 times, right? Every 2 plays. And then divide by both turns. So you get 50 cents per play. That's your expected value, right? So these guys here, their expected value are the same. He's just doing it 10 times over, right? But what happens is the odds of this 1/3 failing chance happening every single time, right? It's smaller now. Because this is like, say this is your market risk, right? The odds of 10 of these all failing is smaller. Does that make sense? But there's something called correlation that plays into effect here. So we can see here, right? These are the different lines. They all start at a 10% standard deviation. And then this is how much, so this is the standard deviation. This is how much risk you have, basically. The bottom is how many shares you buy. No, how many assets you buy, right? Of the same risk profile. So right there, investor A will be 1. He'll be up here. Investor B is 10, right? He will be one of these streams. Now what happens is something called correlation plays into effect. Let's say all 10 of these, right? They have 100% correlation. Would the diversification matter? Nagar, would diversification matter if they're 100% correlated?
In that case, they're 100% correlated. They're all the same.
Yeah, 10 is equal to 1 because they all move up and down together, right? If they're 100% correlated, it doesn't matter how many times you do this over, which is why you see the higher correlated assets, right? This is 60% correlation. You get the diversification doesn't help you a lot, right? It's something called the shrinking marginal diversification benefit. So it means each extra diversification, right? The more you diversify, the less benefit you get. See how the terms like flatten out, right? So for example, for something that has really little correlation, you can get, by diversifying, it helps you, right? But for something with like a lot of correlation, diversifying helps you less. With 100% correlation, diversification doesn't even matter. Does that make sense? Because they move all up and down together, right? Now, let's say a good amount of money to diversify is 20 stocks, right? 20 stocks, because this is where, you know, the shrinking marginal diversification benefit starts to reach 0, right? Each further stock you add isn't going to move your line lower anymore. Right, so let's say 20 stocks. What's the problem with buying 20 stocks? Like, not the problem, but what's hard about buying 20 stocks? Harry,
2 reasons.
what's hard about buying 20 stocks?
Global progress towards poverty. What are 2 strategies to reduce?
Sorry, Sean, I'm going to skip here, is that okay? Janet, what's the problem? Not a problem, but what can be hard about buying 20 stocks?
Yeah, what would you call it?
Come on in, take a seat. Sit closer. What's it? Nathan, right? Okay, let's say you want to buy 20 stocks for diversifying, right? What can be hard about that? No, not that. Yes, Leo.
You have to keep track and monitor each of their performance, right? If you only have one, you have to keep track of one.
Generally, it would be what?
Yeah, it's a hassle to track and research 20 stocks, right? And also the other thing is trading fees. If you're trading 20 stocks, right, each trade costs you $10. The costs add up. So what do you do to mitigate this? To find a solution to buying 20 stocks without it being a hassle? Yes.
I don't have a chart, but if I was to like even a chart
Mutual
like
funds.
this,
Mutual funds. Yes, that's what we're going to talk about next.
I would say
Index funds. And 2 types, ETF and mutual funds. So we're going to start with index fund. So an index fund is something, it's a fund, right? It's either an ETF or a mutual fund. Its whole goal is to track an index. So what's an index? Name an index for me, Kyle.
I don't remember the name, but I remember you showed it to us, and it was like, it like
describe
predicts the stock market or something.
you know, the number.
Yes, but I want a name. Nathan.
1820 to.
S&P 500, right? Let's say the S&P 500. Where's my notes?
sorry, describe extreme poverty. Okay,
Here.
Oh.
Sorry, to describe extreme poverty.
Right, so you have your first index, which is called, what's another index called? Because that's gonna be a good question.
Chris.
Dow.
The Dow. The DJIA. Now, the S&P 500 is a bit deceiving because there's actually not 500 stocks in there, it's 505, right? So the S&P 500, it's an index that's made up of 505 stocks of the biggest American companies, right? It represents 80% of the American stock market. And the DJIA, the Dow Jones Industrial Average, it's 30 companies, right? Now, can you actually buy the S&P 500 or the Dow Jones Industrial Average? Steven, you want to come in? Okay, buy. Do you think you can buy the S&P 500 or the Dow Jones Industrial Average?
So, from
Leo, no?
2000.
Right, because it's an index, right? It's not an actual asset. It's just an indicator. So that's why when you hear people talking about the news, right? The Dow's up 20 points a day, 30 points. They don't talk about it in money because it's not something to buy, right? It's points. It's just an indicator. So, how do you replicate the performance of the S&P 500? Janet, how do you replicate this? What's the easiest solution? Easiest solution to replicate? Yeah, you just copy, right? Buy the exact same companies that the S&P 500 has tracking and have the same proportion, right? The same weighting. But what's the problem? Again, it's a lot of hassle, right? Even if you don't need to do research, you just gotta copy this. It's a lot of trading fees. So what you do is you use something called an ETF, which is called an exchange traded fund, right? And what that does, it's this fund, right? It groups, here, let's get to the next one. So this is the S&P 500, right? 505 stocks. This is from 2016, which is a bit less relevant now because, you know, let's say Exxon. Exxon is 1/3 the market cap of Apple here. But now Apple is 20 times the size of Exxon. So this is from 2016, it's a bit outdated. Actually, before we go into ETFs, it's a new allocation, right, of the S&P 500. This is how much they're weighted. So the S&P 500, and Microsoft gets this much weighting. Apple gets this much weighting, right? So this is how much they take up of the index. What's one problem you see with this that we just talked about with diversification? What's one problem you see with this pie chart?
It's in everything.
Harry, what's one problem you see?
Okay. People,
We just talked about it in diversification with this pie chart.
they want more what? Meat. They did meat, right? And then,
Because it's
hey,
like
we've got
just
oil.
a few of the companies
We're
are
changing
make
it.
up most
Which
of
are
it.
some of the other
Yes,
ones.
that's why, right?
Nuclear
Just a
power.
few of these big 5 companies take up half of the S&P 500, right? So if you invest in the S&P 500, half of your money goes into these 5 companies. And we talk about correlation, right? These companies, do you think they're correlated or not correlated? Correlated, right? Because they're all big American tech companies. They have a lot of correlation among them, right? So this is a big problem with diversifying. So let's say you want to replicate this, right? And you don't want to buy 505, right? You don't want to buy, like, say, 10% of Facebook, 20% of Alphabet, 20% of Amazon, and like say 1% of whatever this stuff is, right? You don't want to do that. What you do is you buy an ETF, right? That tracks the S&P 500. So, for example, the most popular one, you guys can look at this later, right? It's called the Vanguard S&P 500 ETF. So what they do is they just copy this thing, right? Their entire fund just copy this. They're replicating it. But you can buy it as one, right? So this ETF, VOO, it's like a stock symbol, right? You don't gotta buy 500 separate ones. You just buy VOO. And then all these, right? All the basket of stocks is grouped together into one. Right? Does that make sense? So that's an ETF. The next one is called a mutual fund. Nathan, what's a mutual fund? Take a guess.
Without any problems from other people. You buy how these are all three
Speak louder.
together.
Yes, but no.
Because we
A mutual fund is something called an actively managed fund, right? It's usually actively managed or it can be passive. So an ETF is passively managed, right? Because people aren't doing anything in this fund, right? They're just copying this. They don't need analysts. They don't need people to research, right? They're just copying this. But a mutual fund will come in here and say, hey, I think Apple will do well this year, right? So what they do is they make it more weight. They buy more Apple, so they overweight this and underweight. Say, let's say I think Apple will do well and Facebook will do bad this year, right? I buy more Apple and less Facebook, right? But the thing with mutual fund is, do you think they charge money for that? Yeah, right, they charge money, something called the expense ratio. How much money you pay to be in the fund, right? So with VOO, the expense ratio is very low. It's like 0.03%, right? because those guys don't do anything. They just copy this thing. But with mutual funds, they're actively trying to, so they're trying to beat the market, right? They're trying to do better than this. And what they do is they overweight or underweight. Now mutual funds somewhere, let's say they charge 1.5%, right? Do you think 1.5% is a lot? If you think it's not a lot, put your hand up. If you think it's a lot, put your hand up. Okay, so everyone thinks it's a lot, and you will be right. We talked about this in the first lesson, right? Everything in stocks, it's exponential. It's not linear. So 1.5% might not seem like a lot, but over time, it'll add up. So this is a graph, right? The red, it's the VO ETF, right? And this is the mutual fund. Let's say the mutual fund does not outperform the market, which they usually don't, right? 80% of mutual funds do not outperform the thing they're trying to beat, right? And let's say they perform the same as the market. It might not seem like a lot, but like that 1.5% over 30 years, right? Investment one goes to 1.8 million. Well, the one with the 1.5% expense ratio, it's only at 800,000. Does that make sense, guys? All right, Janet, what's an ETF? Explain what I just explained. Yes, anything, not just the S&P 500, right? It can be tracing the Dow, it can be tracing the British indexes, right? But it's just a passively managed fund. And the biggest important thing, right? A mutual fund, it's a fund. You invest your money into it, right? But an ETF is like a stock. You can actually buy from the market, right? Does that make sense? Okay, what's next? Stability of equities, and that will be Philip.
Okay, do any of you guys know what blue chips are?
So let's say there's a
Sure, yeah.
Unless the volatile stock.
Yeah, sort of. So blue chips are essentially very established companies, right? And they tend to have very high market caps, typically above $10 billion. What would be some examples, like in our world?
Leo.
Yeah, Apple is a blue chip. Other companies could be Microsoft, but big companies basically, right? And a penny stock is essentially a company that the share price is under $1. It's low market capitalization. Do you guys remember what market capitalization is? Janet?
No, I don't know.
Okay, so let's say a company has 1 million outstanding shares, right? And let's say the share price is $100 per share. What would be the market cap?
100 million.
Yeah, the market cap would be 100 million, right? Because it's the total number of shares times the share price it's trading at, right? That determines the valuation of the company, right? And blue chips tend to be a lot more stable than penny stocks. Why may that be?
Aren't like stocks like more volatile or something?
Penny stocks are more volatile, but what drives that volatility?
Is it because like blue chip stocks like cost more? So if you're like buying like, say you buy like $100,000 worth of like a blue chip stock, and you buy $100,000 worth of a penny stock. If the penny stock goes down, you're losing a lot of money, whereas if the blue chip stock goes down, it's not losing as much.
I mean, sort of. The main reason is liquidity, right? Because with blue chips, there's a lot of people buying and selling, and liquidity basically means, what does liquidity mean, Chris?
How fast you can take your money out?
Yeah, so how fast can you buy or sell a share, right? And blue chips tend to have very high liquidity, right? So one action isn't going to determine the share's price as much as, say, a penny stock, right? Because there's a lot more people trading, right? But with a penny stock, why may volatility be very high?
Because they have a low market cap.
Yeah, and they have low volatility typically, right? So there's less positions to absorb the change that you're creating, right? Does that make sense?
So what he means is like, every time you buy, right, you push this price up by a little, right? It's like supply and demand. Every time you sell, you push the price down by a little. So let's say a penny stock, right? They have $200,000. That's a market cap, right? If you buy $200,000 of stock, you're going to change the market a lot. You're buying the entire company out, right? But let's say you buy $200,000 of Apple stock. What's going to happen? Exactly nothing. You can't move the market. The market is $2 trillion, right? Your $200,000 isn't going to change the market. But in the penny stock, very little money, right, can make big swings on there. And the other thing, it's like, you talk about it too, right? Like liquidity, the volume, the amount of shares available for trading. Like GameStop, right? There's not a lot of shares for trading. So it's very volatile because people have to fight over very little shares. But with Apple, right? Let's say Apple trading $100, right? I want to buy it at $100. If he's still selling for $200, right? Let's say Chris wants $200 for his Apple shares. What I'm going to do? I'm not going to buy from him. I'm going to go to someone else, right? But with GameStop, let's say you're the only one selling. You want $200 for something that's worth $100. I can only come to you, right? Yeah, it's just that. All right, next one. P.
Do you guys remember what PE is? What it's used for? Brandon, do you know what PE is? Yeah, so price to earnings is basically used to find out whether a company is undervalued or overvalued. We covered this in our first lesson, but we're gonna go through a quick review. So price to earnings is calculated by the share price and the earnings per share. And the earnings per share is calculated by the profit of the company. So say a company has $10 million in earnings, right?
So let's just say.
And there's 1 million shares, right? And then the price of the share is trading at $30, right? What would the price to earnings be? So $10 million in earnings, right? 1 million shares, and then it's trading at $30. What would the price to earnings be?
Have the economic power.
$3.
Yeah, it would be $3, right? Because
Where are they gonna
say you have $10 million in earnings, right? And 1 million in shares, right? So you're earning, right, every share is earning about $10, right? However, the share is trading at $30, right? So you have the EPS, which is 10, and then you have $30, which the stock is trading at. So 30 divided by 10 is 3. So you're essentially paying $3 for every dollar of earnings. Does that make sense?
Yeah, we had P before.
Yeah.
Okay, next one. We're going to do liquidation.
They don't just go dump it there. It's like ask.
Nathan, what's liquidation?
Okay, what do they do?
How easy it is to buy and sell it?
No, that's liquidity. Liquidation.
Some company
Let's say someone comes and liquidate your house. Is that good or bad?
Hey,
Bad.
we want you,
Huh?
we are buying garbage from around the world.
No. They're not turning your house into liquid, right?
I know, but I own it, but they're taking money.
In poor countries,
Yes, what they're saying
there's
is,
a lot of
so we're talking about bankruptcy here, right?
environmental.
Bankruptcy, there's 2 types, Chapter 11 and Chapter 7. Chapter 11 bankruptcy means restructuring, right? It means they're not going to sell the company apart, right? They're just going to like restructure the debt. So bankruptcy happens when a company can't pay its debt back, right? And they have to declare bankruptcy. It's like the same with your house. Let's say you stop paying your mortgage, right? Your house is declared in bankruptcy and then you go into foreclosure. The same thing with personally, right? If you owe money to the bank that you can't pay back, you're going to declare bankruptcy, right? But there's 2 types. So Chapter 11 means restructuring.
This is locked.
So let's say, I think General Motors went bankrupt, right?
And they've got
But they think General Motors, it's still a good company, right? It can still make money. So we're going to restructure the debt, right? But we're not going to worry about that today. We're going to talk about Chapter 7 bankruptcy, which is called liquidation. And what that means is liquidation is just they're taking the company and just pulling it apart, right, and selling it in pieces, right? So they're liquidating the company. Let's say you have this company, right, whose assets are worth $10 million. ABC, right? Company ABC. How can you finance a company? How can they finance $10 million in assets? What are the 2 ways of financing? Which one way? Harry.
in place around here. Where do they get most of them?
You want to buy $10 million in assets, right? There are 2 ways to finance it. What's one way to buy it?
Rivers and streams.
Let's say you can't make money right now because you're not a thing, right? How do you get $10 million in assets? Yes.
You borrow money.
Yeah. So one of it. What's that called?
River.
Debt, right? Now in the stock
When
market,
it rains,
debt comes from bonds,
goes
right?
on here.
Bonds are your debt. So let's say you have
all the waste.
$6 million
And it pollutes there.
in debt.
Water.
What's another way to finance the remaining $4 million?
What does it affect there?
Pardon?
Oh, never
There.
mind.
What does water pollution
Brandon.
do to your health?
So, what is your company?
What's that called?
That's one.
So debt and starts with an E.
Instead of using the land for.
Starts with an E. Come on. You weren't an exec, Brandon. Brandon.
Okay, which means now you've got a loss of land.
Starts with E. What is it?
And also the pollution.
Debt and what?
Last thing. You know what the locals do?
Yes.
Gas earnings?
They'll take the waste and do
No, not earnings. You can finance things with earnings when you have a company running, right? But let's say you don't have earnings right now.
They'll
Yes.
burn it for what?
Yeah, equity.
To cook.
Equity, right? You sell $4 million in shares. So the debt is bonds. What is this then? What's equity?
Is not a good
How much
thing.
you own of the company?
No, you're financing it, right? What's equity? What's equity financing? How do you finance with equity? Brandon.
When you look at all this,
Starts with an S, and it's the purpose of this club. Yeah, stocks. Right, so let's say $6 million financed through debt, $4 million financed through equity. Let's say something bad happens, right? Bad S-H-T. Bad stuff happens. Company, it's only worth $5 million now,
where you're supposed to be like, why do they accept those idiots?
right? But this guy owes $6 million
These guys
in
are
debt.
paying them to take the garbage. Watch the video on the e-waste. It's very sad. It's true. It's
So, in the event of liquidation, who do you think gets wiped out first? Meaning, who doesn't get paid?
Oh, I need
Yes.
$7 million.
Yeah.
Like, I don't know about you, but I don't know.
Be more specific. What investors? Because both of these are investors.
Okay, and I actually don't know.
Debt
what
rate,
to do.
yes. Fine.
Oh, you should recycle. Okay.
Before buying
What do they
stock?
do?
Yeah, the equity gets wiped out first, right?
Like, oh my God.
Let's say bad stuff happens, right? Company went from $10 million to $5 million. But let's say they lost $5 million somehow, right? But they still have this, right? $6 million owed in debt and $4 million in equity.
Planned obsolescence.
What happens is this $5 million, right? It doesn't get distributed evenly between debt and equity holders. This $5 million get distributed among debt people, right? So that means they get like 5 over 6 on the dollar, right? So this gets distributed. What do these guys get? Nothing. The most they're getting, it's an apology, but usually that doesn't happen, right? So these guys would get wiped out first. And usually, right, debt will have its own like levels of tranching. It's called tranching, right? Where like different debt people, debtors, get different prices, right? Get different parts of the company, right? We won't have time to go into like how bankruptcy works today. Does that make sense? So if a company goes bankrupt, right, it's very unlikely that the stockholders would get everything. The only case that the stockholders get anything, right, is if the company's worth more than $6 million. So the debtors have to be paid in full before the stockholders even get a single dollar. Does that make sense? So when a company declares bankruptcy, the stock goes to zero because it's going to be worth nothing if they actually go bankrupt, right? All right, next. Oh, we already talked about this. What best represents the stock market? Phil.
Yeah, okay. So, what best represents the stock market? Well, that would be the very, very large indexes such as the S&P 500, Dow Jones, and NASDAQ. At least within the U.S., right? Because say the S&P 500 represents about 80% of the total value of the U.S.'s stock market, right? So they have the largest piece in the pie, right? So they would be best to use as a representation of the stock market, right? And then market weighted versus price weighted. So indexes are priced differently. So for example, Dow Jones, which we talked about earlier, it is price weighted. So that means it's based on the share price of the company, right? But with the S&P 500, it's market capitalized weighted. So
back to the thing.
I'll run for example right here. So let's say index A is using market capitalization, right? Let's just say, for the sake of the example, that there's two companies within the index, right? So company A,
Here, use this one.
okay, so let's say company A here has a market capitalization of $1 billion, right? And then let's say company B has a market cap of $9 billion. which one is weighed more within this index? No. Which one is weighed more, the company A or company B within the index? What makes up the price the most? So this is 9 million, and then this is 1 billion. Yeah, company B makes up the majority of the price, right? That's how the price is calculated. So let's just say there's a billion shares, right, total within these two companies. And then the total market cap of the index would be what? Shannon? $10 billion, right?
This is okay?
So then the index, say, would cost $10, right? And $9 is company B, and then $1 is company A, right? So it uses market capitalizations as opposed to share prices. So let's do index B now with price weighting.
Wait, Phil. Does that make sense? So like, say, if company B goes up, right, by 10%, it's going to make a bigger move on the index than company A going up by 10%, right? So company B gets more weighting in that sense. That makes sense, right? Yeah. Like this one's market, S&P 500's market cap weighted. So these company gets such a big slice of the pie of this whole index, right? Because they're big market cap. They're very big market cap. Okay.
Okay, and then we'll do price weighting, which the Dow Jones uses. So let's say company A has a share price of $90, right? So A, $90 is the share price. And then let's just use company B again. It has a share price of $10, right? Which one would be weighed more, regardless of market capitalizations? Nagar? Yeah, company A would be weighed much more, right? Because the actual share price is 9 times that of B, right? And let's put this into a calculation here. Let's say, what is the total value of index B, of the share prices? It's $100, right? And then let's just say for the sake of this example, there's only 2 shares within this index. There's 1 share of company A and then 1 share of company B, right? So that's the total outstanding shares, right? So let's just put 2 stocks. And then let's say the index is priced at $50, right? Company A makes up much more of the index than company B, regardless if company B has a much higher market capitalization, right? Because the numerator here is share price, right? Does that make sense?
Yeah, this is how they just weight stuff. The other one is like equal weighting. Every single stock in the index gets the same weight, right? So Phil just talked about 2 different weighting. You either weight them by market cap, so whoever has a bigger market cap gets more weighting, or you weight them by price. That makes sense, right? Okay, we're going to go into the big boy stuff now. Whoa.
Oh, there's the question here. Why would the stock market not represent the economy of a nation?
Can I take over from here for a
Sure.
second? I'm going to pick on Harry. Why would the stock market not represent the economy of the nation? Think about right now, right? The stock markets are at the all-time high, record-breaking highs. But look at the economy. It's not necessarily in the best mood right now, right? But why would the stock market not best represent the economy of the nation? Give me one reason.
Is it because the stock market is also based off of
I don't care.
consumption?
I rape and pillage the land, the water.
Because it really depends on the situation.
Okay, good one. Chris.
It's an analysis of speculation.
What do you mean by that?
Because the stock market is speculated, because by got into presidency, people think the market's going to be better, but in reality, it's not actually better.
Yes, that's a good one. Remember, first day I said, nothing determines the price of the stock, right? The highest bidder and the lowest seller determines the price, right? The stock market is based on what people think it's worth, right? The economy is based on what it actually is. And the other thing is time, right? The economy looks at the past, right? For example, Q2 results come to you at the beginning of Q3. So the results are delayed, right? Same thing with, like, say, the pandemic. The stock markets are high because people think about the future, right? The stock market, it's a representation of not the present, but what people think will happen in the future. If people think things are going to be great in the future, then the stock market is going to go up. Does that make sense? And the other thing is big boy stuff. Yield curve. Anyone know what a yield curve is? Philip, pick up someone.
In the back of the gap solid. Yeah.
No, not many countries have certain.
Just take a guess.
Not many, if at all, because it's cheaper to do what?
It has to do with interest rates.
It's for garbage.
Bonds.
Hey, you want
Who here
this phone?
learned about bonds? Who here know what a bond is? Raise your hand if you know what a bond is.
What does it cost you?
Okay, that's fine. So we're going to talk about bonds, right?
Zero.
So a bond is basically borrowing money, right? So let's say company ABC issues one bond, right? Let's say this bond is worth $100. And you buy this. What does that mean? It means you're giving company ABC, right, $100. They're going to give you this piece of paper.
The government. So there's no.
Now it's not paper anymore. Now it's electronic, right? So you own this bond, and they're going to say, okay, this bond, $100, right? You're going to lend us $100. Every year, we'll pay you $5 in interest.
Pause it back. They crush it, reuse it again.
Right? You have a $5 interest per year. What's the yield? It's the same way that's calculated for dividends. What's the yield?
This is a
Janet, what's the yield?
new. I'm talking maybe.
So 5% interest every year. What's the yield?
Very new phenomenon. So this is like.
Pardon?
I don't know if the term.
No,
is
that's PE.
More than 10 years old.
But the bonds don't use PE. It's 5%, right?
Hicks have more.
Now let's say
ability to
maturity.
do it, but they're also the biggest.
Equals 10 years.
Okay.
So what this means is this is $100, right? They're going to borrow $100 from you, right? Every year that they have the money borrowed, they're going to pay $5, right? You have a 5% yield every single year for 10 years, and then 10 years they'll pay you the $100 back. So it's like a bank loan, right? It makes sense, right? It's like a loan.
You would actually.
So they give you this money, right? $5 interest. That makes sense? Now, do you think? Let's say the maturity was 10 years, right?
And how do you?
If the maturity was say 2 months,
It's very hard.
do you think the yield will go up or down? Not the yield, the interest rate. Do you think the interest will go up or down?
That's key.
Nathan.
You also have to be careful because that hurts the economy based on it's.
Mhm. Chris, why?
You look at simple answers.
Because
Like all these
there's
things,
less time for it to accumulate,
It's a whole.
for the yield to
When you
accumulate.
spend time thinking about it,
No, the reason is less risk, right?
because it's not.
Okay, so if the company goes bankrupt, right,
We don't even.
you get paid back
You
less.
asked me when I was your age,
Right.
by the way.
The odds of it going bankrupt in the next 10 years is higher than the odds of it going bankrupt in the next 2 months, right? Let's say this was a day. The yield would be basically 0%, or very little, because the odds of the company going bankrupt tomorrow, it's a lot lower than the odds of the company going bankrupt 10 years from now, right?
10 years later.
It's that uncertainty, because time is
Things
uncertain.
in the air.
And we're going to talk about a yield curve. So
You don't even see some stuff.
let's talk about
You
treasury.
know, if I said to you.
So a lot of governments, they have something called a central bank, right? And central bank is something that determines fiscal policy, right? They determine the interest rate, the inflation, right? They determine the fiscal policy. And let's say maturity, right? You have 1 month,
Those are the things we don't.
3 months,
That's the place.
1 year, 5 year, and then 30 year.
Do your parents drink coffee?
What would this yield curve look like?
Do they have their little
Would it be sloping upwards,
like espresso?
downwards, or flat? Yes. Yeah, right? Because as time gets longer,
Sorry, there's a lot.
you're expected to make more yield, right? The yield's supposed to be higher. So what the treasury represents the American federal government, right? So you hear people talking about like treasury bonds. Has anyone heard about treasury bonds?
Flowers?
Or at least heard of the term? Yes.
I
Oh,
heard about it and I asked you.
Okay, so treasury bonds are just bonds issued by the American federal government, right? So the government is borrowing money from you, right? So the thing with treasury bond, do you think the yield is very high or very low?
Why do you put it in the comments? Just
Nathan.
throw them right there.
Yeah, because
Is it
the American-
energy? Because when you.
the American government is seen as like the safest investment, right? The odds of the American government going bankrupt is very little. And if they do go bankrupt, you're going to have bigger problems in getting your money back. Like the world will be in chaos,
You probably.
right? So this is what a healthy
It's like you might want to
interest rate will look like.
use fertilizers to make
A
your.
healthy yield curve.
Now you gotta go
Right.
buy it.
Now,
which is
the
part of
question was,
energy. Instead, you just go
let's say
from coffee grinds to the
the
ground.
yield curve started looking like this. What does that imply?
Don't
Not what it
say
represents.
things that-
What does an inverted yield curve
I
imply?
know, I'm sorry. Like, well, what is she-
Think about the Kahoot. We gave you the answer to the Kahoot, but now we're explaining why. It's actually, I don't expect you to get it right. It's very, I don't understand fully myself. Yes,
Take a
neighbor.
picture
Maybe
of
it
your
was like a high-risk business that was first taking off, and then once it stabilized, the interest rates went down.
No, the not for a company, for the federal government, the U.S. federal government. The yield curve inverses. What does it imply?
It's the test part. Like,
Something bad's happening.
Yes, it starts with an R. What is that called? Recession. Right. So we're gonna do a bit of a short thing on interest rates, right? When the economy is slowing down, right? Short-term interest rates. So let's say this part, right? Let's say this part. If the economy is doing bad, do you think the federal government will raise interest rate or lower interest rates? Lower, right? Like right now, things are going back. Short-term interest rate is 0. And the reason they do that is because they want to keep the money moving, right? They want people to borrow from each other. If borrowing is cheap, more people are going to borrow. They're going to borrow, go buy a house, buy a TV, buy a car, right? They want the money to start flowing, so they lower short-term interest rates. But why would the government raise interest rates? Yes, Nathan.
You'll see what I mean when we get the breakdown.
No, kind.
Like, they think the economy is gonna go up with the recession is ending.
No, when the economy moves too fast, right? You would think it's a good thing. Like why would we not want the economy to move, go straight through the roof, right? But here's the problem. When the economy grows at a very fast rate, what happens? It starts with an I. Dia, what happens to the economy? If the economy is moving very fast, what happens? It starts with an I-N. No, I-N-F. Lillian.
No.
Shreya.
Inflation?
Inflation, right? Because what happens is people get more money, right? But let's say the production isn't keeping up, so inflation, right? People are borrowing money too much, they're spending too much, it pushes prices up, the prices of living go up too high, right? And what they do is they'll raise interest rates and slow it down. And the other thing is it gives you a bit of a cushion, right? Because if a recession does happen, then you can push interest rate down, right? But if you're already at 0, you can't lower interest rates anymore. And now, we're going to talk about the Federal Reserve. We'll pick on someone and ask them what the Federal Reserve is.
Sherry, what is the Federal Reserve? Just take a guess if you don't know.
A reserved amount of money?
Sort of. It's Tiger.
It's the central bank of the United States, right? They're the ones that dictate fiscal policy. So they kind of dictate what goes on in the other banks, right? Let's say this is the Fed, right? My drawing with the Fed, and let's say you have a little commercial bank, right? This is your local guy. Let's say this is BMO or someone, right? Bank. So how do you push the yield of a bond down? How do you lower the yield, right? The first thing the Fed can do to lower the yield is they determine something called the overnight interest rate, right? So let's say banks are borrowing to each other, right? Because banks borrow from each other at a rate of 3%. Usually the Fed will say, if you want to borrow from the Fed, the rate is 3.5%. Why do you think they make it more expensive, right? Why do you think they make their rates more expensive? Like, doesn't this mean no one's going to borrow from them? Why would they do that? Why would they not want people to borrow from the Fed? Janet. Leo?
So they don't run out of money?
No, these guys, right? They have a printer. You wanna know how they make money? Money just comes out, all right? The reason why they don't want the market to become dependent on them, right? The government only intervenes when they have to. They don't want them to be dependent. So let's say this 3.5 interest rate, right? They don't want people to borrow from them unless they absolutely have to. But let's say a recession happens. What would the Fed do? Kai, what would the Federal Reserve do if a recession happens?
Would it become lower than regular banks?
Yeah, let's say they lower this interest rate to 2%, right? And what that does, it's it forces these guys to lower their rates even further. Let's say they have to lower to 1.5% to keep up, right? Because they influence the market. So So that's how you push short-term interest rate down, right? To control the interest rate. But an inverted yield curve. So, in order to get the yield down, how do you get the yield of something down? We talk about this with stocks and dividends, right? How do you push the yield down? Chris, how do you push the yield down?
Lower interest rates.
Let's say the interest rate doesn't change, right? The amount of money you're paid doesn't change. How do you push the yield down?
But a longer period of time.
No, price, right? Let's say you're $5 is your yield, right? If it's $100, if let's say the bond is trading 100, right? Your yield is equal to 5%, right? But let's say the bond goes up to 200, your yield is only 2.5% right now, right? So, what the inverted yield curve means is that short-term bonds are yielding more than long-term bonds, right? And it means that an upcoming recession is coming. We don't have time to explain why, but just think about it this way, right? This is a graph of the 10-year treasury rate versus the 3-month rate, right? So this, whenever it goes into negatives, it means the yield curve, it's inverted, right? The short-term ones, no, the long-term ones are yielding less than the short-term ones, right? And the red, what's the red? Think about this. 2009, what happened in 2009 or 2008? What's the red represent? Yes, Leo. Mm-hmm. So yield curve, an inverted yield curve has always predicted a recession coming, right? Okay, last one, quantitative easing, and then you guys can go. What is quantitative easing? Has anyone heard that term? Mr. Holmes? Cool.
I'm listening.
You used to work in finance, so.
I'm listening.
Hi. What is quantitative easing?
Like, is it like the amount that you get to make it like less risky or something?
No. Oops. Okay, we're going to go back to our example of the Federal Reserve and your little commercial bank. So quantitative easing, it's a way for governments to inject money into the economy, right? Now, what's another way to inject money into the economy? Think about it.
There's more money.
Yeah, to print. Name a country. Okay, Nagar. What's a country in the past that did this? They were like, hey, we're running out of money. What do? Print more money.
Germany.
Starts with W. It's Germany, but remember the actual name of Germany back then? The Weimar Republic.
Weimar,
Right. Right? They just started printing money, but what that does, it's that you have inflation, right? And the idea of quantitative easing is that you can kind of inject money into the system without creating too much inflation. So here's what the Fed does, right? How do they get this money? Do they make the money? Do they go out and earn this money? How do they get the money? Shreya, how does the Fed get this money? They print it, but now they don't print it, right? They just credit themselves. They type in money, they type into the computer, right? Give myself $100 million, right? So they get $100 million. Here's what they do. They go out, right, and they buy this bond. They buy bonds, right? Either corporate bonds or short-term treasury or long-term bonds, right? And what they do is they buy this bond, right? So these guys swap. Now the Fed is holding bonds, and the bank is holding money, right? And what they want to do is they want to inject liquidity into the market, into the economy, right? They want to inject this money into the market. So they want the bank to take this money, lend it out to people, right? Or lend to other banks so people can start spending again, right? It's a way to stimulate the economy. But the good thing about this is that it technically doesn't add any new money to the system, right? You just swap bonds out for money. Right? So you want to promote liquidity. And there's some added bonus to this. What's the added bonus? Remember when we talked about how to push the yield down, right? What's the added bonus of the Fed buying bonds? Harry. Let's say the bond right now, right? This bond, it's worth $100. It pays $5 in interest rates, right? So 5%, right? What that means is, if you want to borrow money, you have to pay someone 5% to be competitive. Let's say you're the same risk profile, right? You got to pay 5% to be competitive, right? Now, quantitative easing, you buy bonds, right? When you buy something, what happens? Same about supply and demand. What happens when you buy something? Janet, what happens when you buy something?
Price goes up.
Yeah, price goes up, right? Let's say this bond, right, goes to 120. Now the yield, what's the yield? Does anyone have a calculator? No, okay, let's just say, I'm gonna guess it's 4%. Is that right? Okay, yeah, 4%, right? The yield pushes down to 4% because the interest rate doesn't change, right? The price of the bond goes up because the Fed keeps buying it, right? So it's 4%. And what that does, it's interest rates are lower, right? It also allows the government to borrow money at a lower interest rate and be competitive. Does that make sense? By buying, so the Fed buys the bonds, right? It injects the market with liquidity, right? Promotes people to start spending money and stimulate the economy, get it back going, get it going again, right? And it also pushes the yield down, which means the government can now borrow at a lower interest rate and still be competitive, right? Because they lowered interest rates all across. Does that make sense? All right, we'll end it here. If you're applying, is anyone here deciding on applying for exec? Cool. Okay. So, if you're, do you have an op block? Okay, so the thing is, next week we go through semester switch, right? If you have an op block on Wednesday, you probably won't be here. And then if you do, you have to let me know, okay? Otherwise, like we said, if you're accepted into the in-person group, you're kind of, you're expected to be here because otherwise we'll swap you out, right? Does that make sense? Okay, cool, thank you guys.
Thanks, Tiger.